In this video, we're going to talk about financial statement analysis. That is, looking at a company's financial statements and trying to assess some performance metrics to that company. So we're going to be looking at lots of things, lots of numbers, lots of statements. So we've talked about financial statements in general in some other videos, but the first thing we want to do is look at how we might analyze these statements themselves. And one of the tools we can use is something called a common size statement. And essentially what these statements do is it converts line items on a financial statement, it converts them into percentages so that we can make some comparison to the history of the company. We also can make some comparison to line items for our competitors to see where we line up with some of our better competitors. But let's take a look at these balance. The first one is called the common size balance sheet. And what it does is it takes all the numbers on the balance sheet and it divides them by total assets. So you see here, total assets is 100%. And down below here, total liabilities and equities, also 100%. We know that has to be true because they balance. And as you can see, we can go and see how a company has done over time in these different areas of the balance sheet. I also have provided a column that can do some averages for us. So in this case, it turns out that on average, the company has roughly about 4% of its total assets have been in cash. Fixed assets, net fixed assets, about 26%, and intangibles are about 42%. And by the way, I forgot to mention what this company is. This is Disney. So you know that Disney does have a lot of intangible products, lots of trademarks, lots of copyright information. They have a lot of intangible assets. If we look down below here, you see that long-term debt is about 31%. Short-term debt, current liabilities, about 18%. So total gives us this about 50% of the financing, right? About 50% of that is long-term, and it's debt. The rest of it then obviously is common stock or equity. We can also look at the common size income statement, and there's some very interesting things to talk about here when you're thinking about performance measures. Turns out that about 56% of the income goes to production, which leaves about 43% left over to pay the rest of the bills. Operating profit is about 22% on average. Some years have been pretty good, up in the 24s, 25s. This last year was a little different, so maybe we want to explore why it dropped from 24 to 15. Net income itself is pretty good for a company. 18% is the average. So we can see that in general here, there's a way of understanding how these statements are fit together. And this gives us some averages to look at. I mean, it's interesting to understand how the company is, how it stands relative to itself and relative to others. So what is this ratio analysis all about? So for each ratio, we should ask some questions. How's it computed? What's the ratio trying to measure? Why is that true? Why is that measure? What makes that true? What is the unit of measurement? It's very important because some are percentages, some are times. What is the value? What does the value that you see, what does that indicate about the company? And then finally, how can we improve the company's ratio? So again, they're not very helpful by themselves. We need to compare themselves to something. So we can do trend analysis, looking at how we've done over time. And we can also do peer group analysis. So we can compare to similar companies or similar industries. We can also look at how we get this is look for their SIC or the NAICS code will tell us what industry they're in. And we'll talk about this here again a little bit when you think about the project. There are instructions for how to gather the data that you need for these financial statements. What kind of problems are there? Again, there's no real theory as to why we say this works, right? So there's no way to know which ratios are most relevant, which ones are the most truthful, the most significant. Benchmarking's kind of difficult since so many companies are different. Globalization and international competition makes some comparisons difficult. We have to worry about accounting procedures, fiscal year ends, extraordinary kinds of events. All of these things create some problems. Some of them there are techniques to fix, and some of those we just have to incorporate those difficulties in our analysis. So again, what is analysis all about? There's lots of ways to analyze a company, and most ways serve a purpose, and they do it very well. Some of it is strictly for internal use, some of it is for external use. So if you wanted to have a template to try to say, how would I analyze a company? Let's assume, as we're going to talk about here in a second, we'll talk about liquidity ratios. Well, what does that category mean? Describe it, right? Talk about good numbers, bad numbers. How does this thing? What does this category tell us about the company? And again, you should be able to get. I would think you should at least be able to get 2 or 3 paragraphs to talk about each one of these categories. Now, what are the ratios that are in the categories, right? You need to define them. What does each one of them tell us? There's a graph. What does the graph tell us? Is it good or bad, right? How can the company improve on their performance? And of course, in the end, you want to summarize the findings for that category. Now, one of the things I want you to kind of keep in mind, though, this is analysis. By definition, that means it is an opinion. So as long as you're giving good logical relationships and you're matching the analysis with pictures and tables, etc., then the answer is, as long as it's logical, the answer is, well, who knows, right? That is your opinion of what happened. So as long as there's some logic, nobody should question exactly what you mean, right? I mean, it should fall into place. So what I would look for each category that I'm figuring you probably have 3-4 pages, because we're going to have some pictures, right? You're going to have 3-4, maybe 5 pages for each one of these categories that we'll be discussing. So what are the categories? And what I've done is I've kind of listed these in a group project motive or a concept, if you will. Because this is what we're going to do as an assignment for my classes. In the first paper, you'll talk about the history and industry, and you'll give me that analysis for the company. That's due the second week of the course. And then every week after that, there's a new paper due. Paper 2 is about solvency, short-term solvency or liquidity ratios, long-term solvency or the financial leverage ratios. Week 3 We're going to talk about asset management or turnover ratios. Sometimes we refer to these as efficiency ratios. We'll talk about profitability, and we'll talk about the market value ratios. And finally, the fourth paper, there are some miscellaneous ratios, some of which we'll talk about in class, some you've probably seen in textbooks, but the final part of the paper then obviously is just an overall summary of what you've learned about the company that you're looking at. So, what I would like to do now is just start with the first category. The first category is liquidity. How quickly can assets be converted into cash? Those that can be converted the quickest are part of this liquidity ratio set. So essentially we're looking at short-term things. Current assets, current liabilities. The more liquid a company, the less likely they'll experience problems meeting short-term obligations. So let's look at the ratios. There are 3 of them. The reason I put these in this, categorize these or label these 1, 2, and A, is that when we go and look at the graphs, I've provided data so that you can find the industry numbers if they're necessary. So if there is a number, what that means is that there is a ratio in industry ratio worksheet, I'll show this to you in a second, that has industry data. If it has a letter A, that means that there's no industry number that you can use for that particular ratio. So let's look real quick at what I'm speaking about here. So here is our ratio analysis. Now what you're going to do for your company is you're going to find a company, and the first thing you'll do for your company is you need to get the data for your company into this spreadsheet. And it'll take a little bit of time. It all comes from either Zacks.com or you can get it from YahooFinance.com. Both of them will provide the data that you need for this information. In addition, you may have to go out and find some information from an annual report. So you may have to download some annual reports. Those annual reports may have some data for you. All the yellow boxes are places where you need to put numbers. If you don't see this thing here, make sure negative numbers are input, etc. So we have an income statement, a balance sheet, and down below here, what I have is something called the industry average ratios. Now you're going to need to get this data from a library. Our library has it. It's called RMA Statement Studies. And this is a publication that has industry average numbers for the ratios. So what you'll do is you gather this book and you're going to find your company's NAICS number. You can just Google that and you can find out what the number is to use for your company. Find that in the publication, and then you'll input the data into this spreadsheet. The only thing I want to give you just a little clue, because it's a little tricky, is this ratio right here, long-term debt to net worth. That's our debt equity ratio. When you see that number in Robert in the RMA book, it lists it not as percentages but as times. So they'll tell you that long-term debt is 1.4 times what net worth is. So that means it's 140%. So that's the only one where you have to play games with and convert it from times to percentages here. But again, what we have is once you have input the data, then most of your work for this spreadsheet is done. All of the ratios are calculated for you. All the ones we're going to use. There's all these datas here with averages, right? We have all these different ways to analyze what's going on inside a company. There's just a tremendous amount of data. Now, what I want you to use, and what I would think you would want to use, is we have a series. I'm looking for a particular, I'm looking for the very first one, the liquidity ratios. Down below these labels, these are all graphs. So here's the liquidity ratios. This is the picture that you see right here in our in my PowerPoint slide. So again, the data that you need once you input the financial statements, the data that you need is all here. So although external data is important, and I want you to use some external data if you can get it, I expect you to use the graphs that I provide so that we can all be looking at the same kinds of pictures and analyzing the same types of data when we're looking at these ratios. So for short-term solvency or liquidity, we basically have three ratios: the current ratio, the quick ratio, and the cash ratio. Going down in scale here, we're going to more and more conservative types of measures. So basically this tells me, can I pay my current obligations? Current assets are essentially cash within the next 365 days. Current liabilities are all the bills that I have to pay in the next 365 days. If this number is greater than 1, it means we have more cash than we need. Now, once we get beyond the current ratio, though, when you get to the quick ratio, we're going to take out inventory. And for some industries, inventory is such a huge asset that this quick ratio will be much below 1. Right? It could be like for grocery stores, it's usually around 0.2, 0.3, 0.4, because all they have for assets is inventory. So when you subtract that out, it's a huge change in the numerator, and obviously it becomes much smaller. The cash ratio, I think, is just a very basic. Do you have enough money in your checking account to pay all of your current bills? And of course, nobody has that. No person typically has enough. Certainly no company is going to have enough in their checkbook to pay. But it is nice to see how stable this number is, right? Is there cash holdings? Are there cash holdings stable over time? So let's look at these ratios quickly. As you see in the table, this says TAP, but it's actually not. It's Disney. So this is Disney current ratios. The orange is the industry. So here's the industry, and down here, this one is core. So you can see that the difference, the industry is much more liquid with respect to the current ratio than Disney is. When you look at the quick ratio, they're much closer together. Now the industry, for the most part, is still more liquid, but it's much closer together than what the other one was. So what does this tell us? It tells us a couple of things about the two companies, or in this case, the industry and the company. On average, the industry that Disney is in has a huge amount of inventory, but Disney does not. They don't have a lot of inventory. And I think if you think about the company, I mean, they certainly have a huge retail marketplace, especially at their parks, etc. But really, when you think of that compared to all the money that comes from movies, TV, etc., inventory is a pretty small piece of Disney's overall company activity. And again, if you look at their cash ratio, you can see that over time it's pretty stable, right? So the amount of cash that they have, cash, right? This bottom line, it just doesn't change that much. So we can see that in general, overall liquidity, Disney seems to be a little bit less liquid. But in general, when you get real conservative, just not a tremendous amount different from the industry. So their liquidity is really not terrible. It's not great, but it's not terrible. The second set of ratios then to look at are financial statement analysis, or their leverage ratios. In this case, we're going to be looking at a bigger picture, if you will. Let's look at the right-hand side of the balance sheet and let's see what's there. We want to ask two questions. How much debt do we have? And can we pay for the debt that we have? Right? So there's a question of amount, and then there's a question of ability. So if you look at the ratios above the black line, those are the ratios that are going to tell us how much debt we have. Below that line tells us whether or not we can pay for that amount of debt, or maybe just give us a picture of the amount of safety that we have. So let's think about this first ratio. The debt ratio, DR, is total debt divided by total assets. This tells us the percentage of assets that have been purchased by borrowing. Now, when we talk about borrowing here, we're talking about total, short-term and long-term. So there will be companies that have very little long-term debt, but they have lots and lots of short-term debt. So again, those numbers are going to be reflective here, just the percentage of assets that are purchased by using creditor money. On the other hand, the other ratio, debt equity, this just looks at long-term things. What is the relationship between long-term debt and net worth? Now, this ratio, the debt ratio, can never be over 100% because there has to be somebody who owns the assets, an owner. But the debt equity ratio can definitely be greater than 100% because it's not looking at a relationship of the right side of the balance sheet to the left side. It's looking at the relationship within that column. So debt equity can be greater. All it's doing is saying of long-term financing, how much of that is debt and how much of that is shareholder. Down below, we have two ratios, very similar ratios, but they represent our ability to pay. The first one, the TIE ratio, is earnings before interest and taxes divided by interest. Again, the higher the number, the greater our ability to pay. Now, this isn't a cash flow number, so it doesn't guarantee I'll have the money to do this, but it gives me a picture of ability to pay. Cash coverage converts the TIE ratio into a cash flow number by adding depreciation. So again, gives us more of a cash number. Did we generate enough cash this year to cover interest? Now, the biggest problem with these ratios at the bottom, it's about ability to pay, is that they don't include everything that goes along with debt. It doesn't include principal. So if we wanted a more conservative picture, we might add here interest and principal due this year. So if we put that principal due there, that would give us maybe a better picture. So let's look at leverage then. Here's the debt ratio and debt equity. Again, the brown and the blue. Right, here's the blue. This is Coors. And again, the brown here, you can see this is the industry. And in general, the industry finances its assets with more debt than what Disney does. So Disney keeps a relatively low amount of debt. Debt to equity, if you look at the debt, that long-term financing, you see that the industry has a lot more long-term debt than what Coors does. Coors, again, keeps it less than, in general here, less than around 70% of their long-term financing is with long-term debt. For the industry, it's 150% of their long-term financing is with debt. So the industry uses a lot more long-term financing than Disney does. Well, so what's the big deal with that? Why does it matter? Well, if interest rates are rising, right, and you can get some long-term debt at a lower rate, that might be the way to do it. So there's lots of reasons why this relationship holds. We just have to understand the risk element. How risky does it make the company when they're financing their operations in this way? If we look at the TIE ratio, you can see that in general, Disney has a much higher TIE ratio, with the exception of this 1 year. I don't know what happened in 2017. But in general, you can see that their ability to pay, in general, is higher than the industry. However, it does seem to be on a downward slope. So something has happened in this last year that we went from 13.8 to 2. So it was a tremendous drop in our ability to pay on interest. And again, if you look at the cash coverage ratio, again, you see we went from 31 to 15. So there is a downward slope in this cash coverage or our ability to pay. So I'm sure the management of Disney is looking at and paying attention to this type of operation to make sure that we always have the ability to pay on our debts. Just a few more ratios to look at. There's something called the debt to enterprise value. So let's talk about, first part, we have something called net debt. It's the total debt of the company plus the excess cash and short-term investments that they have. So it's just a cash and short-term investment number. And we want to divide that by enterprise value. And we'll talk about enterprise value throughout the course. But essentially, the enterprise value is what it would cost to buy the company, buy all the stock, pay off all the debt, and then take this company private. That's what enterprise value is. What would it cost to buy the equity and pay off the debt? To leave it with a zero debt company that is privately owned. That's enterprise value ratio. Again, this how much debt do you have compared to this total net value? Again, the higher the number, the greater the risk in times when times go bad. The equity multiplier is just another way of looking at the debt ratio, essentially. It takes total assets and divides it by the book value of equity. So it gives us kind of a reciprocal, if you will, of the debt ratio. But again, we're going to actually use this in a later analysis. That's why I bring the equity multiplier into our discussion here. So here's our debt to enterprise value. You can see that over the last couple of years, it seems to be in an upward movement, right? There's more debt relative to the enterprise value of the company. And likewise with the financial leverage multiplier, again, you see that Disney has a lower financial leverage. So their risk level with respect to financing is much less than what the industry's amount of debt is. So that's the end of this video. I'll look forward to seeing you in the next video.